The stock market can feel overwhelming when you're just starting out with complex terms, charts, and expert opinions everywhere you look. You might think you need to be a financial guru or have deep pockets to start investing. But if you've been putting off investing because it seems too complicated, then this video will change everything for you. By the way, if we haven't met, I'm Justin Saffel. Growing up, I checked food stamp balances at public funds, but I transformed my financial future through financial independence, retire early principles, and systematic investing. Now at 38, I'm a financially independent investment advisor managing over $5 million in assets, and I help working professionals escape the paycheck to paycheck cycle and make work optionals decades earlier without extreme frugality. And in this video, I'm going to show you exactly how to start investing in the stock market through 7 simple steps, the same system I've used to help complete beginners build 6-figure portfolios without getting overwhelmed. Every month you delay investing costs you thousands in potential wealth. Today, I'll show you why starting now, even with a small amount, matters more than waiting until you feel ready. All right, let's break down these 7 simple steps to get you started investing today. The first step might surprise you, has nothing to do with money. Step number 1, decide what kind of life you want. Most people rush into picking stocks or mutual funds without this crucial first step. Before investing a single dollar, you need to know what you're working towards. This foundation will guide every investment decision you make. Here's what typically happens. Someone gets excited about investing, throws money into random stocks they heard about online, then panics and sells when the market dips. Why? Because they never connect their investments to their actual goals. Without a clear vision, you'll chase whatever's popular or scary at the moment. I've watched clients lose thousands of dollars making emotional decisions because they lacked a clear why behind their investing. Some say this step is impractical, that it's just dreaming. But having managed over $5 million in assets, I can tell you that clients who succeed are those who know exactly what the kind of life they want to build. So here's what you do. Take 15 minutes today and just write down your ideal lifestyle, how you want to spend your time. What does financial independence mean to you? When do you want to retire? This clarity will make every other investing decision much, much easier. Now that you know what kind of life you want, let's turn that vision into a concrete financial goal. So step number 2, set a financial goal. A vision is great, but you need to translate that into some specific numbers. Most people skip this step because they feel a bit intimidated by the numbers, but I'll make it simple. Today, we'll focus on setting one clear financial target. Here's what I see constantly. People saying that they need to be rich or have enough for retirement, but those aren't goals. Without a specific number, you'll never know if you're on track. It's like trying to drive somewhere without knowing the address. I had a client who wanted to retire early, but had no idea of how much money that would take. Once we calculated his actual number, which ended up being like 1.2 million, every decision became more clear. Some argue that picking a specific number is pointless because life changes, but having a target, even if you have to adjust it over time, beats having no target at all. So start with a simple milestone, maybe saving your first $10,000 or investing 15% of your income this year. Make it specific, measurable, and achievable within the next 12 months. Now that you have your goal, you need a place to invest your money. So let's talk about setting up your first brokerage account. So that's step number 3, opening a brokerage account. Or it may be even better for you to open some type of individual retirement account. Doesn't matter. The fact is here, you need to open an account to start investing. So this is where people get stuck. They think that opening investment accounts is complicated, requires thousands of dollars. The truth is you can open an account in under 15 minutes with just $100 or less. Many beginners get overwhelmed by all the account options and they end up doing nothing. They spend weeks researching, comparing every brokerage feature, trying to make the perfect choice. But here's the reality. Most major brokerages offer similar services, and small differences won't impact your success. What matters is getting started. So I recommend simple, low-cost platforms like Vanguard, Fidelity, Charles Schwab, Interactive Brokers, the more reputable ones. Yes, there are newer, flashier options, but these established brokerages have proven track records and educational resources. So pick one of those brokers, visit their website, open an account today. The process usually takes about 15 minutes or less. They guide you through it step by step. I recommend opening at least 2 accounts. Open a brokerage account and open an individual IRA account. Open a Roth if your income's below 140,000, I think now. Open a traditional otherwise. Once your account is open, let's ensure you never miss an investment opportunity through the power of automation. So step 4 is to automate your investments. Most people think successful investing requires constant market watching and trading and doing this and doing that. But the most successful investors I know do the exact opposite. They automate everything and rarely check the accounts. Here's what typically happens with automation. You plan to invest monthly, but life gets busy. Maybe you need new tires or decide to go out with friends. Suddenly that money you meant to invest vanishes. I've seen this pattern destroy wealth building potential countless times. Some people will say they want to control, they want to watch their investments, timing the dips and all this other stuff like that. But studies show that for the average investor, automating investing and outperforms trying to time the market. And missing just 10 best market years over the 20 years can cut your returns in half. So here's what you do. Set up automatic transfers from your bank account to your investment account, be it a brokerage or an IRA, on the payday or a couple days after. Start with whatever you can consistently invest, even if it's just $100 monthly. The key is making it automatic. Now that you've got your money automatically flowing into your account, let's talk exactly what to invest in and why simpler is better. So step number 5, start with index funds or ETFs. When you're new to investing, you might think you need to pick individual stocks or find the next Amazon or Tesla, but most successful investors I know, including Warren Buffett, recommend a much simpler approach for most people. Many beginners get caught up in trying to pick the winning stocks or timing the market. They read something about making millions on GameStop or Bitcoin, and they think that that's how investing works. But every success story, thousands lose trying to pick winners. I've seen clients lose their savings chasing hot stock tips. The data is clear. Over 80% of professional fund managers can't beat a simple S&P 500 index fund over time. If the professionals are having trouble and can't consistently pick winning stocks, then why should you try? Some might argue that index funds are settling for average, but the S&P 500 has averaged about 10% annual returns over the long term. So here's what you do. You start with a low-cost S&P 500 index fund or ETF. You instantly own pieces of the 500 greatest companies in all of America. You can start with as little as $100. Lots of the brokerage firms offer fractional shares and things like that. But once you're invested, you're going to face a big challenge, staying invested when the market gets rocky. So step number 6, if you're new to investing, ignore market fluctuations. This step is where most new investors struggle the most. Markets go up and down, sometimes dramatically. Your success doesn't depend on picking the right investments as so much as it does your behavior when things get scary. Most people think they can handle market drops until they actually experience one. When the market falls 20% or more, which happens every few years, fear takes over. The news fills with scary headlines, your account balance drops, everybody claims this time it's different. During the 2020 crash, I watched people panic, sell at the bottom, locking up huge losses only to miss the recovery that followed shortly after. Some say you should avoid these drops by moving into cash when things look scary, but if you're new to investing, it's very seldom that people can consistently predict market moves, and the biggest gains often come right after the steepest drops. So remember your long-term goals from step one. Market drops are normal and temporary. The market has recovered from every crash in history and reaches new highs. Finally, let's discuss how often you should check your investments, because it's probably a lot less than you think. So step number 7, track your progress. With investing apps on your phones, it's tempting to check your portfolio multiple times per day, but successful investors know that watching their investments too closely leads to poor decisions. Many new investors check their portfolio daily, sometimes even hourly. It's like a machine gun, press, press, press. But they treat the stock market like a sport. Watching every move, but the constant checking actually just creates anxiety and leads to emotional decisions. During the volatile periods, daily checking becomes an emotional roller coaster, and I've seen clients drive themselves crazy watching every market movement, even though they're investing for decades, and that's the goal. Some say that, some will argue that, hey, I need to stay informed, but honestly, daily market movements are just noise for long-term investors. So here's what you do. Pick one day each month to review your investments and track your progress towards your goals. Use a simple spreadsheet to record your total portfolio value and your contributions. Starting to invest isn't about knowing everything. It's about taking simple, consistent actions that are aligned with your goals. The market will always have ups and downs, but these 7 steps will keep you on track no matter what's happening in the economy. By the way, if you want to dive deeper into some investing strategies that actually work, I put together a free Financial Independence Retire Early Starter course. Just click in the link down below. Hey, I hope you've enjoyed this video, and I'll see you in the next one.